Welcome to our update. This is Akers Financial Group. I'm Brian Akers from Akers Financial Group, and we thank you for joining us today for our talk about the market update. We're going to have Mark DiOrio speak up to us about the markets, go through his outlook with some charts, a lot of good information. After that, we'll have Brian Akers talk about the AFG Select portfolios that we work with and manage through the Brookstone Capital Management and Mark DiOrio's investment committee. We'll also be talking about our events this year and a lot of good information, even about retirement contributions. We'll cover that towards the end of our talk today. As we begin, I am Brian Akers, certified financial planner, president and founder of Akers Financial Group, and I lead our team of advisors and our team at Akers Financial Group. And we want to thank you, the clients, thank you, prospective clients. We do want you to understand how valuable you are. We believe that Akers Financial Group's number one asset is our clients. Our relationships is very valuable. We want to be there when you need us. We want to fulfill the goals and basically I'd call it what we should be doing for you. It's okay to call us. We have phone numbers. We have people there to answer those phones. We want you to do that. Be in contact with your advisor so we can meet and go over and make sure we're doing exactly what's right for you and your portfolio and financial planning. Today is about the stock market and about reviewing, and we're going to have a special guest, Mark DiOrio, as we begin. Today we have Mark DiOrio, the Chief Investment Officer for Brookstone Capital Management, our third-party money manager out of Chicago. Mark, good day. We're glad you're here to talk about the outlook of the market and a little bit about 2024. Are you ready to talk about the markets today, Mark?
Sounds good. Happy to be here, Brian.
Well, I appreciate it. I think it's wonderful here as we start 2025 for you and I to get together. I'll shoot a little video on what's happened last year and really get into what we're looking at this year, especially with a new administration.
Definitely. I think we have had an exciting 2024, and maybe we'll go over a little bit of what to look out for 2025.
Look out for. It's going to be a volatile as things are good and things are bad, and there's going to be more volatility than we've seen maybe in the last 18 months. So what we're going to do is have Mark go through his presentation here, and then him and I will get back together right after his presentation.
Thanks, Brian. Let me jump in. And as you mentioned, going over 2024 to start, it was a pretty exciting year. And the reason why it was exciting was the U.S. led in economic growth. They led the rest of the world. The bottom clip there shows that GDP growth really surpassed any other of the developed countries. And to make the point, I always get asked about when is the demise of the U.S. and competitive threats and so forth and so on. But if you look at the top clip there, the U.S. market now represents about 67% of the all country world index. If you were to go back to 2007, the U.S. represented 40% of that index. So it's clearly showing that the U.S. has been exceptional in terms of economic growth, innovation. And so it's been a very exciting time. And the U.S. continues, as we look out into 2025, to be the driver of the global economy. And the reason why the markets responded very well is that the strongest environment, economic backdrop, I should say, for markets is when you have strong economic growth and low inflation or kind of continuing declining inflation, which is called disinflation. And not deflation, which would be lowering prices, but the rate of inflation slows down. And so if you remember out of 2022, we had high inflation. That was a tough environment for the stock market. But as we turn the calendar to 2023 and then continuing into 2024, inflation has been coming down and economic growth has remained resilient. And this was a surprise to a lot of economists that in 2022 predicted that we would go into a recession and needed to go into a recession. Well, it was a recession that never came, and the market just continued forging higher. And one of the reasons I think that might be underappreciated of why the economy remained resilient, it still remains resilient, is what's called the wealth effect. This was a term that was popular in the late 1990s to explain the economy, which was essentially that, well, as stock prices are rising and house prices are rising and near all-time highs, well, there creates a wealth effect where consumers are apt to spend more and continue spending. So we ended 2024 with that trend well intact, and it's something we'll continue to be monitoring. And the point is that 70% of the US economy or GDP growth is based on the US consumer. And there's pretty much one rule that I've used for about 25 years, which is don't bet against the US consumer. They will spend. But as 2024 moved along, and one of the risks that's popped up is we have a lot of concentration risk now in the market, which is the top stocks, these big mega cap tech stocks, are really dominating the overall market. This is a chart of the S&P 500, which is represents 500 of the largest U.S. stocks. Well, the top 20, just 20 of those stocks now represent over 48% of the entire index. So this is what's called a market cap weighted index. The larger the stocks are, the more weighting they have in that index. So this exceeded the highs in 1973-74 period, where you had this kind of nifty 50, as it was called, period, where you had those top stocks that were driving the market. Then 1999, 2000, you had a lot of concentration risk at that time as well. So whether you do the top 5, 10, 20, as I did in this chart, or 40, it shows that we've exceeded the concentration at any of those other two periods. So it does bring about some risk that we have some concentration risk. When that chart in the orange is declining, that means the rest of the market is performing relatively better than those top stocks. When that mountain is climbing, it means the top stocks are outperforming the rest of the market. So this is a key indicator for us of what we're watching in 2025 to see how this shakes out, to see if other stocks start to participate, and maybe the big caps have gone as far as they can in terms of relative performance. And in fact, the concentration was so great that the fewest number of stocks outperformed the index since 1998, 1999 period, 2023, 2024. It's been very concentrated rally where only about 29% of the stocks outperform the overall index. Generally, that number hovers around 50%, half above, half below. As you can see, it's jockeyed. And this chart goes all the way back to that 73, 74 period. So it's a pretty long period. And so that concentration risk is one of the risks we're looking at from a market's perspective going into 2025. I just want us to take a step back since we're talking about the markets to really understand what's driving the economy and what's captured the market's attention, and that is semiconductors. So just as oil powered the 20th century, semiconductors power the modern economy. Semiconductors are those little chips that you hear about that go into consumer electric devices, into computers, and what they do is process and store data, so compute power and memory power. And the supply chain's really broken up. So you have in the US, most of the major semiconductor companies actually design the chips. They don't necessarily make the chips, so they design the chips. So it's sophisticated engineers. They design the chips and that for the different use cases that they have, and then they put them into a foundry for manufacturing. 60% of the chips actually come from Taiwan. So the foundry is a very sophisticated manufacturing complex. The US only manufactures about 12% today. So going back to 1990, we had about 37% market share. Now we're down to about 12%. So you'll see this pop up. It's actually of kind of strategic importance to our overall economy, but it's very sophisticated manufacturing. And then you go into chip sales. So this is very advanced manufacturing, but semiconductors are needed to power the modern economy is the point. And in fact, the whole industry is based on one of the founders of Intel's comments, which is now known as Moore's Law. So this is from Gordon Moore, which is essentially that the number of circuits or chips per device will double every 2 years. Essentially, the powers getting and capabilities are getting stronger. And this has really held since 1970 and is expected to hold going forward. And if you look at the end markets, so naturally you'd think, well, computers, so whether you're processing data or storing the data for the computer, those are different chips. Then communication devices, of course, has really grown over, especially over the last decade or so. Autos is interesting as 15% market share. The average car today has about 1,500 semiconductors in it. And then you go into industrial or military uses, and then also consumer electronics in everything from your oven to your TVs and so forth and so on. So it's really taking up a big chunk of the economy and what we've grown used to. Historically, the end markets have been for digital, kind of laptops, data centers, smartphones, and analog use cases, which is automotive and industrial and consumer electronics. But over the last year and a half or so, and continuing into 2025, a new entire market has really developed, and that is to power AI, artificial intelligence, and so some of the early leaders in chip design have really grown. And these are the most advanced chips coming out of the marketplace. So a company that became just recently, and it jockeys around, but became the largest company in the US, NVIDIA, was the dominant player in AI. They're not the only one. There'll be other semiconductor companies as well, but that's been an early leader and kind of a leader in this marketplace for AI. So that's a whole nother kind of area to sell into for these chips and a whole area of big demand. And in fact, I mentioned strategic importance. If you look at these CHIPS Acts, the US in 2022 enacted the CHIPS Act really to bring back chip manufacturing into the US. And we're talking pretty big money. So 50 billion, I think, has been spent or is in the process of being deployed. But I believe that bill allows for almost 250 billion in that range. And then the rest of the world is also putting in their own economies, kind of investing in their own economies to develop that chip production. And Taiwan, you see overall being a major player, and that's why they come up geopolitically as well as they keep popping up on the radar as being so important because of the production of semiconductors coming out of Taiwan. So powering AI. Artificial intelligence, the early leaders are what's called large language models or LLMs, and the big tech companies, and what's driven their performance is because they've had most of the data coming in to work. So you needed a lot of data to iterate and develop and train and build these AI models. But as we get a little bit more mature, you're going to see some additional software layers on top of these base LLM languages. So this is an early advancement. They need a lot of semiconductors to process a lot of data at the speed that they do because you're talking about producing these next generation of artificial intelligence. But there'll be other winners besides just the mega cap tech. And we may see that transition in 2025 or later 2025. The other interesting part is that AI is not just about semiconductors or tech. You need about, and estimates range, but between 30 to 50% more energy in the US to generate enough power to run these systems and run all the compute power necessary. So you might have seen an uptick in and an interest in spending on nuclear power plants. And these aren't the big power plants. The power plants now are going to be small modular reactors, which are smaller in scope, really to get power into these big data centers that are going on around the country. And you even saw recently a Stargate program that the Trump administration, in coordination with a couple of business leaders in this area, started talking about putting in 500 billion into this industry. Part of it is, and a big part, is the energy needs and how do you get the energy. And so all sources are on the table, but you also have to locate these data centers close to these power areas. So it's very exciting. The winners are not just tech or AI related. This is broad based in the overall economy. The value chain of AI is very similar in sense to thinking about the energy markets overall. So there's an upstream utilities. You need power, and some areas work better with businesses than other areas. So you have upstream utilities, you go to midstream, these are the generator kind of turning this into power, switching companies, and so forth. Then you go downstream, and what you have is basically a big warehouse with all these processes in there. You have semiconductors in there, and they're running all this. And even something which has kind of gotten hot behind the scenes that you don't think about, which is, well, how do you also cool all these systems? So there's advancements in that technology as well. So that's downstream um, um, in that AI value chain. So there's a lot going on. It's a much bigger cross section. It is kind of this modern economy that's being built right now. So it's a very exciting time. In 2025, we started out this year actually with one of the concerns was, well, the Federal Reserve is lowering short-term interest rates, but longer-term interest rates were actually rising. So the 10-year Treasury was actually heading towards 5%. And there was some talk that this was a concern for the market. But if you take a step back, what this chart reflects is in orange is the 80-year average of interest rates given their different time to maturity. So on the left, 3-month, 3-year, 5-year, 10-year, and then the long term. And the blue line represents today's interest rates. And what you'll notice is they are very similar. In other words, um, uh, today's interest rates look almost identical, and maybe by later in the year will look practically identical to the 80-year average. So instead of being concerned that interest rates are abnormal now, they're actually normalizing from an abnormal period. Talking about policy uncertainty and what might transpire, it's a unique case where you can look at President Trump's first term and how did the market react during different focuses. So in 2017, there's more of a tax focus. And what outperformed in blue there was actually growth stocks. That's broad cyclicals is what it's called. And when you have a tariff focus, what you actually see in orange, even though it's going down, is showing growth stocks underperforming the traditional defensive sectors such as staples, healthcare, utilities, and traditional telecom, what we call the shut index. So it could be, depending on where the focus is, it's not necessarily the whole market that might be selling off. It may be, well, growth is in favor one period, and then if there's more of a focus on tariffs, now you switch to those more defensive names that can perform pretty well. And one of the reasons I mentioned that big cap tech outperformed the and became very large part of the index and highly concentrated, but that may change later in 2025 is if you look at the blue bar here, that is earnings growth each quarter. And the Mag 7, the top 7 tech stocks were really outpacing the rest of the market. Their earnings were growing much faster. But as we get to the back half of 2025 here, in the orange bar, the rest of the market actually catches up. And so there won't be necessarily a reason to pay that much of a premium relative to the rest of the market. So a lot of stocks haven't participated in the rally, and this will give them an opportunity to do so, I think. And so there could be a catch-up phase for the rest of the market, and maybe not all the market action will be concentrated in those big cap tech stocks. So I think this is about a broadening type of market, a broadening environment going forward. We do a lot of cyclical work, meaning we look at different cycles, how the market has performed historically. And we like the presidential 4-year cycle, meaning you have the first year, second year, third year, and then the fourth year is the election year. Of course, that was last year. And the way we used it last year was to say that the market actually remained on an uptrend, a general uptrend for the year. In other words, it usually shook off a lot of headline risks that you'd think in an election year. And historically, it ended positive. So we thought that that was a good way to at least stick with the trend, stick with the uptrend, and not get spooked out on any headline risk. In 2025 is the first year of the election year. When we look at this chart that shows how the markets have performed, is that you have this honeymoon phase for, let's say, the first 6 months or so after the election or after the inauguration. But then by the back half of the year, you may get into some sideways action where the market may have gotten overvalued, overexcitement, and now started to take a hard look and said, well, we rallied during the election year into the first year. and now it may be set for some type of pause at the back half of the year. That would be completely normal for that to happen. That might go into the second year of the presidential cycle, which is historically the worst year, but it's important to point out as well that at some point it bottoms and then starts to head higher into that third year, which happens to be the best year of the presidential cycle. So if you think about how well that worked previously, the second year being the worst year, well, that was 2022. That was a pretty tough year in the markets. Then the third year was a strong year, 2023, and then 2024 continued that trend. And then 2025 being the first year of the presidential cycle. We think this is a good way to look at the market at this time. And of course, we'll adapt as information comes and as data develops. But this is the historical trend. So this is what we'd be looking out for. If we saw that rallying really into July, let's say, of this year, or mid-year sometime, then we want to make sure that we're definitely diversified at that point, and not get overly excited and overly aggressive with the market. But a very neat stat, Brian, and this is the last slide I have, which is uh, years that end in five. Historically, years that end in five have had a very positive return. In fact, there's only been, since 1895, there's only been 1 year with a negative return, and that is 2015, and that return was less than a negative 1%. So I think this is a fun slide to keep in mind as well, and to kind of turn it back over and end on.
Thank you very much, Mark. It's really interesting on the year of the five. I guess that keeps us alive with the positive returns. Is that something we can bet on this year, or will there be a lot of volatility? This seems like we're going to have these markets running up and down based on sort of the political piece makes me just think volatility is something we're going to look at for 25.
Yeah, definitely. So you're entering the third year of the bull market. Historically, those have not been as strong, but that doesn't mean you can't have strong periods. But it does mean, to your point, that you'll encounter some volatility, and that volatility could be a surprise to the marketplace, whether it's technology based or it's, as you mentioned, it could be just a policy issue, and the market's trying to figure it out. At the same time, you have maybe this transition of, well, you have these big cap tech stocks that have dominated, and now you have all these other stocks that are looking at like they're in a relative value mode where they can catch up at any time, and maybe the big cap tech stocks start to come off a little bit in price. So that naturally can create some volatility for sure. So I wouldn't abandon any disciplined strategy for just the year that ends in five, but it does
Yeah.
say that,
Well, it
okay,
sounds like it's a year and five. We might as well just go all in, right? But that's
yeah,
not really what we're recommending here. The
yeah, correct.
volatility, we really haven't seen a downturn of more than 10% in a couple of years, right?
Yeah, so the average decline in any given one is year is 14%, we'd say. And that's a correction. Anything greater than 10% is a market correction. And so that's really hasn't gone on for a couple of years. So we're past the average. Usually it's about every year, at least on average. It doesn't happen every year, but it would happen every, let's say, 14 months. You'd get at least a 10% correction. So we're overdue just on a calendar perspective. And
Yeah.
so I wouldn't be surprised if we got one this year for sure. And it's not something that you have to necessarily nimble away from. It's just something to prepare for and put in your strategy and embed in that. And I know you do that, Brian, when you build the portfolios. You have some
Yeah.
defensive components and additional diversifiers.
Absolutely. Now, Brookstone Capital Management is our third-party money manager, and Mark manages many pieces of the portfolios. And so, when you are doing your presentation, I think about things that you imply with when you're talking. One of them is basically that the market in the first year of a president, the first 6 months are usually pretty good, and then some volatility comes in. And then the other one, you actually introduced us to something called a yield curve that actually curves up. It's not, it's a crazy thing that hasn't happened in, I think, 12 years or more. So those are two topics I just wanted to ask you about before we finish for today.
Sure, and I think that's the strange part where everyone, the headline maybe in the media is that, oh, the 10-year Treasury could rise to 5%. Well, that's very normal, especially in an economy that's growing. at our clip, which is solid, very normal. So we're almost going into a normalized world. And so the yield curve, a normal yield curve, is where short-term rates are lower than longer-term rates. And I think if the Fed ends up cutting rates one or two more times, that would actually get you exactly to the 80-year average of 3.75%. And then the 80-year average is 5% on the 10-year. We've been between 4.5 and about 4.85% to start the year. Well,
Mhm.
that would be very normal, I think, a very normal operating environment. But it can cause some volatility as you get to normal. But as to your point as well, which is we just haven't been in normal.
Yeah. We went so low that everybody wants rates to go that low again. And the reality of we're not probably going that low again sort of makes people nervous because that slows the housing market down a little bit because they're not sure if they should lock in. There's always the promise of refinancing where they can save some money in the future, but the reality might be rates might drop a little bit on those mortgages, but not a lot. When they're tied to prime, I think that takes the Fed rate you're talking about that could drop, and usually they add 3% to make it the prime. And it's just a weird thing for like financial decisions, like the younger people that have the mortgages and have to finance debt and want to buy the new place or the next place. And there's a huge decision that's going to drive the market with the housing. Do you see that this year? Housing getting better or still being slow, or what do you think?
Yeah, I think still being slow in terms of transaction volume, just like we've seen. We're not at a position, it's not like a 2006, 2007 into 2008,
Right.
where you have this oversupply of housing. In fact, we have an undersupply of housing. So that's what's keeping prices relatively stable as opposed to coming down quickly. So it's a lot different environment than it was back then. So we wouldn't see that type of crisis.
Yeah.
It's really more on the affordability
Yes.
issue, which is you have elevated prices and you have a little bit higher interest rates than a lot of those prices were established 2 to 3 years ago.
Absolutely. All right, Mark. Well, we thank you very much for the market look back a little bit and a little covering of what's going on in the major pieces of the industries that are driving the market currently. We do look forward to 2025, and we thank you for managing our clients' money through Brookstone Capital Management. And thank you again for joining us today for this outlook.
Thanks, Brian.
We do thank Mark DiOrio for his information about the market update. At Akers Financial Group, we've used Brookstone Capital Management since 2013 as part of our third-party money managers that we have. Now, Akers Financial Group, we work through Arcadius Wealth as our registered investment advisory firm. We are investment advisory representatives of Arcadius Wealth. We're also stockbrokers through Arcadius Capital, which allow us to have other portfolios set up through our Fidelity NFS custodian. Now, Akers Financial Group, we believe in financial planning. That financial planning leads us to investment design and active management. That active management, we really do that through Brookstone Capital Management by using different sleeves, different types of management, and putting it all together into your account. One of the things that we try to do is we build a core portfolio and then we add a satellites on top of that. Satellites are other styles of investing that could take more risk or less risk depending on your risk tolerance, your goals, like if your goal is for income immediately or for no income and you want growth. Do we want a portfolio that's tax advantaged or do we not care because it's a Roth IRA? We want it just to grow. So we have built some core models called AFG Select that I like to go over with you. The AFG Select portfolios are portfolios where our investment committee, myself, Alex Monk, Bernie McVeigh, Jeff Akers, and Paul Franco are on that committee, and we meet on Mondays to talk about the markets, the asset allocation, and the portfolios that we then take our ideas to Brookstone Capital Management's investment committee, led by Mark DiOrio, and they put together and finish up the AFG Select portfolios. So what I like to do is go over a little bit of that. What I wanted to do is go over the AFG Select models. AFG, Akers Financial Group, we select through our investment committee, and then Mark DiOrio and his committee reviews and questions and then designs everything and then implements through their trading platform. We began this in July 1st, 2017 with 4 core portfolios. This is our income portfolio, our moderate portfolio, our moderate aggressive, and diversifier. Each one is built with broad diversification, which leads to lower risk than the market itself. We try to work the portfolio in a way designed based on the way the core portfolio is set up. Income has an objective of income, of providing income with diversified aspects into the market. So what we have on the screen right now is actually what we're invested in right now and the allocations that we are right now. A moderate portfolio is more designed for people that are having that core portfolio of money where we want to have lower volatility than the market and we want to be diversified. One of the things that we do when it comes to our portfolios, we diversified by US and international. We diversify by large, medium, and small. We believe in diversifying in commodities and even having actual gold and silver metal in our portfolios as a way of hedging different pieces of the markets as things go up and things go down. You'll see in our moderate portfolio at the end of 12/31/2024 that we had dividend portfolios, we had utilities, we had healthcare, we have small cap funds, consumer staples. We also diversified the portfolio in many, many different ways throughout the year. And one of them was we went equal weight on the S&P back in May of 2024. On the moderate aggressive portfolio, the big change here is we have extra percentages applied to technology through cyber security ETFs, exponential technologies, and through having more in the Fidelity Contra Mutual Fund. The manager there has done an excellent job for us over the years. And then we built a portfolio, a core portfolio called Diversifier. This is to offset any investments that you might have that might be index related or market related. So we built a portfolio of non-US market investments. International, gold, silver, commodities, a little bit of real estate, all are in this portfolio to help us have a hedge against the US market to balance us throughout the years. Now, what you'll see is down here for 2024, you'll see the net of fees portfolio. We took the highest fee, which is 1.5%, which is for small accounts. We took that fee and as we calculated our return for the 1 year. So last year was 16.59 on the moderate aggressive, 13.98 on the select moderate. On the income model, we made 8.81 total return. And diversifier averaged 11.83 last year, giving us a 5.39 on diversifier since we started, 4.97 income portfolio, 7.66 on the moderate, and moderate aggressive 8.32 since 2017. So these are our returns. This sheet is available to you through our offices at Akers Financial Group. We cover year by year, month by month returns also on that same sheet. As we're talking about the markets and the outlook for 2025, I just want to review a couple of things with you. One thing would be the 2025 limitations for savings and things. So let me share that information with you. All right, so what you're seeing on your screen right now is retirement contribution limits for 2025. They really haven't changed a lot. And so the idea is the fact that when you invest money in 2025 through your 401k or 403bs, your regular contribution is $23,500. That's for everybody under age 50. Once you turn 50 years old, you can add another $7,500 to a limit of $31,000. Now, this year, first time under the Secure Act 2.0, if you're turning age 60, 61, 62, or 63 this year, you can actually, on the catch-up, add $11,250 to the portfolio to your retirement savings instead of just $7,500 catch-up. So that's a good idea there, a good way to save money, a good way for you to consider putting money aside. Under IRAs and Roth, the limits for 2025 is $8,000. You can still contribute for 2024 all the way through April 15. Now, if you're under age 50, you can do $7,000 for last year in 2024 and $7,000 for this coming year. Now, there's lots of plans out there, SEP IRAs, simple IRAs, all kinds of ideas. There is income limits on Roth. So you need to know and need to speak with an advisor about what is the best options when it comes to saving and growing your money. Now, what I want to make sure you guys understand is that Akers Financial Group, we're here as financial planners to talk to you about your situation, your exact situation we call your financial fingerprint. And we want to help you right where you are and with our team of advisors, provide for you the information that you need. Now, we do that through our radio shows. We do that through our individual meetings with our clients. Our radio show is called Winning in Retirement. It's on Saturday at 10 a.m. on WCBM 680. It's on 11 a.m. on 105.7 The Fan FM. And now this year, 2025, we're also on Sunday morning at 9 a.m. on WCBM 680 for those that want to listen live there. You can also listen on podcasts, Winning in Retirement. You'll find it right there. You can listen anytime. And of course, to the Akers website at akersfinancial.com.
Hi, my name is Kim Haight. For those of you who do not know me, I coordinate all the events here at Akers Financial Group just for you. We have many things planned this year. We have a very full calendar, which will be on our website shortly. So you'll be able to see the list of those things we have coming up. We have a lot of educational talks this year. Most of those will be held in our Forest Hill office. Most sessions will offer a lunch or a dinner, your choice, whichever you prefer. One of the upcoming sessions will be titled, What Happens at Age 59 and a Half? One of the things the advisors will talk about is that you have the ability to do an in-service rollover from a company plan to an individual IRA. And that's why, and they'll talk about why that might be a good thing for you to do. You'll definitely want to save the date for our big client event. A Winning in Retirement Training Day will be held Friday, October 10th at the Water's Edge Event Center. You don't want to miss that, and you are welcome to bring your friends and family that might benefit from that. The clients that we have that are veterans, we just love honoring you. And once again, we're going to be having a veterans luncheon just for you on Tuesday, November 11th at the Bully Rock Golf Course. And please remember, you're always welcome to share videos, emails, invites with your friends and family. We greatly appreciate and just thank those of you who do refer your friends and family to us. We just so appreciate it. We wouldn't be here without you. And please reach out with any questions you have about any of the events to, you can email events@akersfinancial.com, or you can call me directly, it's fine if you have any questions. Thank you for taking your time out today to watch our video, and we just hope you found it informative, and we will see you next time. Thanks.